Okay, welcome everybody to GDC West 2016 tax-based presentation. First off, we'd like to thank our judges. So we have Kristen Haig from Potash Corp, Ashley Lund from Golden Healthcare Management, Irina Kovrenko from the University of Regina, Dave Nielsen from Collins Barrow PQ LLP, and Jill Johnson from Camco. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask the presenters questions. The volunteer timekeeper will show time cards at various intervals to indicate the remaining time, and will stop any speaker who exceeds the maximum time limit. No questions, comments, cell phones, or picture taking will be permitted from the audience at any time. The audience will only be permitted to applaud following the question and answer period. The audience is banned from any material that bears the name or symbol of a competing university. And we ask that the audience exit the room immediately following the question and answer period. Competitors, you may begin when you're ready.
Grace, you started Can Energy with your own hands. You built it from the ground up using the skills that you got from Husky. You won the contract, and not only that, you built the business from the ground up. And now you're in an enviable position where you own the entire company, and a competitor has recognized you for your talents. They want you to work for them because you're that good. You're in an enviable position that not many people can be in. So today, we're going to help you with two primary things. First, we want you to have the best option in both controlling your business as well as having a safe source of income. So with that in mind, you have 3 options. The first option is to keep running your business the way you have been, owning it, but facing the high risks associated with the oil and gas industry now, and trying to expand west with limited funds. Or you can accept the partnership agreement, which would put you on a partner track in 7 years. Take the chance there, hope that you make partner. Or, in our opinion, the best option, option 3, would be to sell your company, become a director, and do something that you're so good at, that you love so much, but at the same time have the ability to have domain over your business. Once we figure out the best plan for you, we're going to help you use the funds generated to help you with the proper retirement plan. Remember, today we're going to help you minimize tax burden and achieve excellence in maximizing the flexibility. So here's the agenda for today. First of all, we'll evaluate the current options that I outlined. Then we'll evaluate the new option that we want to talk about. And then finally, we'll move on to retirement planning. So now I'll pass it off to Tanisha to talk about the evaluation of the current options.
Thank you, Johnson. Now, Grace, you have these 2 wonderful, fantastic opportunities ahead of you. You either remain status quo and retain control of your business and earn a considerably, very consistent stream of income. Or you can take the offer from ECAN and become an employee for 7 years, and then you might be a partner for them. Which option is better? Now, we evaluate these 2 options using quantitative method and also qualitative method. Quantitatively, we discount the present value. We calculate the present value of the cash flow for 7 years by discounting the streams of income and also taxes payable for you for 7 years. We also keep in mind that we use this 7 years figure because you only become a partner with ECAN after year 7, probably. And because we don't have enough information on what the partnership will entail, that's why we only use the 7 years to calculate and compare these 2 options. So let's take a look. Now keep in mind that we don't have enough information on all of the expenses and the calculation that the calculation needs, so we make some assumptions here. First assumption is that you will by remaining status quo, you will win either of the contract from the government. This is because you have 50% success rate. The second assumption that we made is that expenses after you win this contract will remain the same, besides income tax, of course. And the last assumption that we made is that we use a discount rate of 5%. And now we will show you the calculation later on if you have any question. But after using these 3 assumptions, we arrive at the present value of the cash flow being $354,000 approximately. The second option is to accept ECAN's offer, and we also made some assumptions here to calculate the present value of cash flow. First assumption is that you're required to sell CAN Energy immediately. We think this is a fair assumption because it is very unlikely that ECAN will wait for you for 2 years to sell the business before they want you to take on the role of an employee. We also use evaluation by using the 3 times EBITDA method, that is 3 times earning before interest, taxes, and depreciation and amortization. The third assumption that we made is that you will get a bonus of 20% every year. This is by being conservative because the offer says that you can gain a bonus between 20% and 40%. And lastly, same as before, we use a discount rate of 5%. And with these assumptions in mind, we arrived at a present value of cash flow being $497,000 approximately. Now, quantitatively, you can see that accepting ECAN's offer is better for you significantly, but we also want to evaluate other considerations qualitatively. Now, we have 4 different criteria here: the tax implication, control, expansion opportunity for you, and also job security. Now, with the status quo, tax implication is low. You have the flexibility of income deferral. By retaining the income that you earn in the business, you don't have to pay it out to yourself, and therefore you don't have to report really high level of income tax personally. The corporation tax rate is lower, therefore we think that it is more beneficial to have the option of keeping your cash inside the business. With accepting the offer, the tax implication is high because you have to report all employment income that you earn when you earn it. You don't have any deferral flexibility here. Control is our second criteria. And with status quo, you have high control of the company. You're still the owner. You get to do whatever you want. You control all operations. With accepting the offer, control is low because now you're an employee. You have to listen to all the orders from the shareholders, from the CEO of the company. Expansion opportunity. With status quo, the opportunity is low. You want to expand to British Columbia and really grow in your business. But right now, you're working already 65 to 70 hours per week. You don't have enough capital in the company, and you don't have any support. You're the sole controller of the company, and everything, all the decisions are made by you, so really it's not feasible for you to really expand at this point. By accepting the offer, the company ECAN will give you the support that you need, all this control, and also you will be able to expand into larger clients in Western Canada. Job security. For status quo, job security is high. You remain the controller, and you have a stable operations and also a stream of income. By accepting our offer, job security is quite low because you are required to build new relationships with new clients. That will take several years. You have no experience working with larger clients, so you really don't know what the outcome of this new employment would be. And there is also a current slump in the energy market. So if you don't hit the targets that the company gives out to you, you might not become a partner, you might get fired, we don't know. So this is really uncertain, and you might not obtain the partnership in the end. With all of these different criteria in mind, we set up this matrix for you to evaluate different options. You can see that either if you become an employee for ECAN or remain as status quo. There are several advantages and disadvantages with these 2 options, and we believe that these 2 options are not really the best for you. And we will go on and explain the third option, which is the best option for you, with Johnson's.
Okay, so just to recap, these are the metrics that we're using to show you the best alternative. And now we have the third option of renegotiating ECAN's offer and making sure that you can sell the company and become a director level position within the company. Now, for the sake of time, the cash flow analysis and the tax implications are very similar, both in accepting ECAN's offer or renegotiating ECAN's offer, just because you're selling the business, and not only that, you will generate the same amount of cash flows from the salary contract that you'll be signing. So in reality, it really comes down to the qualitative, if you will, expansion, security, and control. But first of all, how would we go about this business? Typically speaking, when we want to sell a corporation, the owner would like to sell the shares of the corporation. And this is for really two main reasons here. You get to utilize something called lifetime capital gains exemption, as well as the fact that in this situation, to meet your corporate objectives, what you want to do is you want to sell to ECAN. ECAN probably does not want to share control with you. I mean, they offered you a 7-year track to partnership, meaning that they will want control of your business. So you want to sell. And what lifetime capital gains does for you is it allows you to essentially save an enormous amount of tax on the capital gains you would have on the sales of the shares. So mind you, when you started the business, the book value of the shares was very low. But now it's worth something. The fair market value is most likely around $360,000. So you would have an enormous capital gain. How do you offset this? By utilizing the Qualified Small Business Corporation and utilizing the Lifetime Capital Gains Exemption. These are the criteria that you have to use. It's a Canadian-controlled private corporation, which you are. And 50% of the assets that you own have to generate active business income for 24 months. So that means you're in the business of consulting. Your assets have to generate consulting income. And upon the sale of your shares, at that time, 90% of the assets have to be used for the active business income. That's fairly easy to do. All you have to do is sell the non-active business assets, and you'll be fine. This allows you to utilize $813,600 of lifetime capital gains. Your capital gains will probably be around $360,000. So upon the sale of your business, you wouldn't have to pay any taxes. Now, just a reminder, the cash flow analysis and the tax implications are fairly similar for both accepting ECAN's offer or going with our new proposal. I just wanted to recap that. Now, when we look at the opportunities for expansion, we wanted to help you expand your business into Western Canada. Now, you get to do this at a low risk because ECAN will put up the $250,000 investment. And the reason for this is the market is so volatile. The gas prices, it's a cyclical industry, so you never know what's going to happen. And in this scenario, if you were to put up the $250,000, which you may even have trouble generating, you could lose it all. And not only that, you have contacts in Alberta, which is, let's be honest, the biggest source of oil and gas in Western Canada. You can leverage this to both target the small to medium businesses, and eventually, you can use these contacts to help you get larger businesses, which ECAN wanted in the first place. Remember that it's the business relationships that takes years to build before you can generate any type of income. So this will be crucial. And not only that, you're working 70, 80-hour weeks. By getting some operational support from ECAN, what you can do is take some of the workload off. Make sure that you can run the business that you want to run while ensuring that you can decrease the workload so you have a little bit more flexibility in your life. So you can expand with low risk and manage your workload with this option. Not only that, we wanted to provide you job security. And as Tanisha has mentioned, the partner track is a fairly risky venture because it's as if you're a 7-year test to see if you're good enough to be a partner. If you were to go and try to operate with the large corporations, you don't really have the expertise in that. And the performance that you would have would suffer. So by maintaining your own domain over your business and doing something that you're really good at, by targeting small and medium corporations, what you'll be able to do is increase your performance, which will help you hit the targets that the partnership track has hit, which means that you'll be able to achieve the partner position in 7 years, easier. And not only that, the last metric is control. You have been a business owner for a very long time, and it's very difficult for someone who's run their own business to give it up and just listen to people and become a salaried employee. This is going to help you run your business because you control your subsidiary. You know your employees better than anybody else in the regional market. So you are going to be able to target different customer bases when you want to with an efficient team that will learn as you go along. And not only that, you will have a little bit of an oversight from ECAN. That being said though, you get to still control the business of CAN Energy. Still a little bit limited, but it is better than just accepting the offer that ECAN has proposed to you and losing all control. So this is the re-evaluated metric that we'll be using. Now you're going to renegotiate ECAN's offer, and this is going to help you with the cash flows. You can't defer taxes in the tax implication circle, but that being said though, it'll help you expand. It'll maintain your security of position, and not only that, it'll give you some control, which means that you can essentially be the business owner that you once were, but with more security. One last thing that you wanted us to look at is the difference between a partnership and a company. This is 7 years down the line, but it is something that you might want to consider right now. What is a company? Well, the benefits of a company is the fact that you have limited liability, and typically speaking, the company is taxed at a lower rate. The cons are that it's administratively a hassle. Typically speaking, you have your accounting fees, your legal fees, all these things that you have to take care of, as well as the setting up of the corporation, which can be quite costly, and there are multiple complexities to assigning dividends and all of these things. That being said, though, the partnership helps you share profits. You are a partner, you put in to buy a portion of the business, and you get to share the profits. And you get to, if there is a loss year, utilize the losses generated from the partnership to offset any personal income that you might have. Not so relevant to you, but it's still something you should look into. And now, the major cons is that it can be an unlimited, it can have unlimited liability or limited liability. And from this stance, we weren't quite sure if ECAN was a limited liability partnership or limited partnership. That being said, though, if you are a partner, you could effectively have unlimited liability in the partnership's operations. If it is a limited liability partner, what you put in is what you can lose. That being said, though, the investment amount would be quite substantial, so that is something that you definitely want to check over. And you are responsible for the actions of other partners. So the partnership is fairly large, I believe around 30 partners. So if any one of those partners does something wrong, the entire partnership is in jeopardy. So you have to consider that into account when you take up on the partnership position. It is something that is optional. You can just remain a salaried director, and this is something that you want to consider for your future. Now I want to pass it off to Fred to talk to you about how this is going to help you with your retirement planning.
Thank you, Johnson. So Tanisha and Johnson have done a very good job at explaining why we want to sell the company. But what does that mean for you? What are you going to do with the money from the sale of the company? Well, let's talk a bit about that. So, first things first, we took a look at your current financial situation, and a couple of things popped out at us. You've got a credit card balance, you've got a store card balance, and you've got an outstanding mortgage. The thing with these is that you're not necessarily getting a return on them, but the interest rate kind of works in the opposite way. If you pay this off, you're not necessarily gaining, but you're losing less. And 19.5% and 28% is a pretty big difference between maybe a 2 or 3% gain on your investments. So with the cash flow you have and with the cash flow generated from the sale of the company, we definitely recommend that you pay off these outstanding loans as soon as possible. Next, let's talk a bit about personal tax savings vehicles. You've currently got $175,000 invested in your RRSP, and to recap, that's the Registered Retirement Savings Plan. There's some nuances, but at its core, it's a tax deferral mechanism. You get an immediate deduction on the money that you put in, so it's as if you never earned that income, and then later, down the road when you withdraw from the RSP, then you get taxed on it then. Hopefully you're at a lower tax rate then, and if you're retired, that's probable, and then you get a lower tax basically. There's also an eventual conversion to a RIF, but that's a bit more nuanced, and we can discuss that in the Q&A. So, TFSA. You currently don't have any investments in a TFSA. This is a relatively newer personal tax savings vehicle, and it's on an after-tax basis, so pretty much the entirely opposite process from an RRSP. How it works is that you get taxed on the money now, and then any funds in it grows tax-free forever. So, comparison. What do you do with an RRSP and a TFSA? Well, an RRSP is safer, it's for your retirement, and there's a lot more you can do with it. So we recommend generally putting lower risk investments in there, and particularly American stocks. The American government has a treaty with Canada, and how it works is that dividend-paying American stocks aren't charged withholding tax, so you pay a bit less tax. With what happened yesterday in the American market, this might be an interesting time, and it might be time for you to buy American stocks. It's crashed, it's pretty low right now, and it'll go back up eventually, so if it's for retirement and if it's long-term, it's probably a good idea. TFSAs, on the other hand, are entirely tax-free, so you want to put high upswing investments in there, particularly shares in a startup, if any are available to you. Next, we have a couple risks and mitigations that we wanted to go over. Business valuation is an art, not a science. There's many different ways to go about it. The method that you used was 3 times EBITDA. There's also 5 times EBITDA. There's valuation of the assets. There's possibly 100 other ways to do it. And people have built their careers on it. So we just want to make sure that when you sell your company, you're selling it for the right price. And to do this, we want to make sure that you hire a chartered business valuator to ensure that you have a proper selling price, that you're getting your money's worth for this company that you've worked so hard to build. Another thing is that, as Johnson mentioned earlier, sellers prefer to sell shares and buyers prefer to buy assets, and there's that conflict there. So the fact that you're going to be in the company with ECAN managing the company you sold, if this plan goes through, does help mitigate this already. But the idea of an earn-out clause is also something that you could float during the renegotiation process. This essentially ensures that the net income of the company that you're selling is going to stay within a certain threshold, and that the buyer is going to get their money's worth. So, rough implementation plan. We've gone over quite a bit today, and we've explained a lot, but what are you going to have to do? Well, first things first, we want to make sure that you value the company correctly. If you don't have a proper valuation, then the renegotiation process for the contract is going to be not as accurate. So start that. Once that's done, you sell the business, and we project to have that done within the next year. You definitely want to pay off your credit card and store cards. You want to open up the TFSA and invest the money as soon as possible, and continue investing and save for retirement. So this is where you are after the plan. ECAN owns the company, they hire you, and you manage the company that you built, and you continue expanding with the support of this great company. So we've gone through quite a bit today, but at its essence, both of the current options aren't necessarily the most attractive. We've come up with a third solution that we feel addresses all your needs, and also provides you with the cash flow to save for your retirement and live comfortably for the rest of your life. So, in conclusion, I feel what we've done here is that we've helped you minimize your tax burden and maximize your flexibility so we can help you achieve excellence. Thank you for having us today, and we'd love to take any questions you have.
All right, judges, you have the floor.
Why wouldn't I pay off my mortgage right away? Could I not just pay it off with all the cash I get out of the deal, and then if I want to reinvest, I could just borrow the money back and deduct all my interest then?
That is a possibility. However, in the information presented to us that you gave us, we had some gaps in information, and the interest rate on the mortgage wasn't explicitly stated. So it's possible that you might want to pay off your mortgage, especially if it's a relatively high interest rate. But if you could make more money doing other investments, putting your money somewhere else, then that's a better option, because you can use that gain to increase your mortgage payments and pay it off later. So you're making more money, basically.
I was just saying I'd do a shell game where I just pay it off right away and then re-borrow it, put it back in the market, and suddenly my interest is deductible. Pay a penalty on the interest rate differential? Does that work? Like, I don't have to, I can still have a mortgage.
So you want your corporation, so you want to pay off the...
Well, if I get cash from the sale of the shares, I'd pay it off, and then right away instead of paying it over time. And then just if I want those to have investments instead, I'd re-borrow, just borrow on the account, borrow on the mortgage again, borrow $1,000 for security, and get the money and put it in the market. And then I'd be borrowed to invest, and then I could write off the interest, right?
So you want the interest to be deductible for your personal
mortgage. Yeah.
For as an individual, the interest rate that you get, the interest expenses that you pay are actually not deductible for an individual. They're only deductible if you are a corporation. Therefore, that situation wouldn't apply to you, and you wouldn't have to gain on that.
Are there any vehicles that are, like, if I don't need all of the cash from the sale right now, is there any way I can defer paying tax on that sale?
Defer paying tax on the sale of your company.
So the company was sold at around $350,000. You would have a $350,000 capital gain, which was offset by the lifetime capital gains exemption that we would use, because we could definitely make it a qualified small business corporation, but already you've owned it for so long, and most of the assets are used to generate active business income. So we believe that it should be already a QSBC, which means that you wouldn't have to pay any of the taxes upon the disposition of your shares.
What if ECAN doesn't want Can Energy as a company? What if they just want me? Then do I have any alternatives? It's like, what if we go to them with this plan that I sell in my company and they come back and they say, no, we don't want your company, we just want you. What would be the next step? Or do you have any other alternatives to counter a situation like that?
Well, if option 3 isn't on the table, and that's been thrown out, then of course we still have option 1 and 2. However, we feel that if you come back to the negotiating table saying that this company is vital to how successful you are, and it's really a part of you, it's something you've built, all your connections are also with the company, everything that your employees work for also helps you, that all makes you more effective, and that all makes you more attractive to ECAN when and if they choose to purchase your company. So while options 1 and 2 are still on the table, we feel that option 3 is very likely based on the relationship-based nature of the consulting industry.
Any other questions? All right, thank you, Jessica.